Good morning, stackers. How about if we do some money in the morning? Let's get ready to record this thing. Hope you're having a great day. We are having a very, very busy day today. Lots of writing this afternoon. We are writing scripts this afternoon. This morning, Richie is putting the finishing touches on tomorrow's show notes, and I am hanging out with you right now. Just recorded some stuff for the final pieces for tomorrow's show. And what else did we do earlier this morning? Oh, I wrote a newsletter to you, which you probably received. Put the finishing touches on that. And then tomorrow, later on, it's all writing all afternoon. It's actually kind of cool because when I first went from being a financial planner and moved into financial media, I really wanted to be a writer. Like my whole life, I wanted to be a writer. And now I was thinking this morning, I write nonstop and I think nothing of it. So the writer's life is not the glamorous thing that I thought it was, but it sure is fun. All right. Almost as fun as hanging out here with you. Oh, hey, Daryl. All right. We got to get this recorded fairly quickly because Abby Chow is waiting for us for our SB Live, and you can ask your college planning questions.
And now, your first Money in the Morning headline.
Okay, those are good. All right, headline 1, headline 2. I think we're about ready to go. You know, it's also funny when I've got like 15 browser tabs open, but a bunch of them are about fish jokes because we're trying to put a lot of stupid fish jokes into the Stacking Benjamins, into the Stacking Benjamin stuff we're writing right now. That's the other thing I never thought. I never thought that I would be sitting at my desk with a bunch of fish jokes. 50 years old writing fish jokes. Hashtag living the dream. All right. Okay, let's try this. Here we go. Paying off debt. That's the number one concern for millions of Americans. And maybe it's your number one concern. And as you know, paying off debt isn't easy. Since I've switched from financial planner to financial media, I've seen wars in the press. People, it's like Hatfields and McCoys, people. Do I use Debt Avalanche? Do I use Debt Snowball? Do I use technology? Do I use 0% credit cards? What do I use? And it's frustrating. What's the best way to pay down debt? Well, we're going to talk about that on today's show and diversification. Will it save you from the next market crash? You're going to find out all that and more right about now. Live from my mom's half-finished basement, it's Money in the Morning. Hey, Stackers, I'm Joe Saul-Sehy, Average Joe Money on Twitter, and welcome to the episode of the podcast where we take two financial headlines in today's press, and we talk about the definitions, maybe the concepts, talk about what's important in those, and then to cap it all off, like the cherry on top of the sundae, we take both headlines and we send you home with a big idea, and that's going to happen on today's show. Money in the Morning is brought to you by Tiller. You know, when you're looking to spend less time managing your money, managing your spreadsheet, but you still like everything a spreadsheet gives you. If you're a spreadsheet nerd like mom, check out Tiller by using our link, stackingbenjamins.com/Tiller for more on how Tiller works. We're going to talk debt. We're going to talk diversification. We're going to talk market crashes, all that and more. So let's get in the party, shall we?
And now, your first Money in the Morning headline.
Our first headline comes to us from MarketWatch. Americans just paid off a ton of credit card debt, but here's the bad news. This is written by Maria Lamagna. A lot of Americans paid big credit card bills in the first quarter of 2018, and they still have a long way to go. Americans repaid $40.3 billion in credit card debt following the first quarter of 2018, according to a new analysis of data from the U.S. Census Bureau, Federal Reserve, and credit agency TransUnion by the personal finance website Wallet Hub. That's the second highest amount paid off in one quarter since the first quarter of 2009, when consumers paid off more than $44 billion. Now the bad news. Well, before we get to the bad news, let's take a second there and talk about that. Isn't it $44 billion? Americans paid off a ton of credit card. If you're somebody that paid off a bunch of credit card debt, how about this? Virtual high five. Let's high five right now. Because paying off credit card debt is not easy. And that's a ton of credit card debt. And if Americans collectively paid off that much, that sounds awesome, doesn't it? How could there be bad news? There can't be bad news. Joe, say it and so. This is the best news ever. People finally get the message. They're paying down debt. Life is getting easier for all of us. We don't spend so much money paying off debt. Instead, we're putting that money in our wallet. And now we're building a future. That's what I hope. That's what we all hope, isn't it? And yet, yes, there is some bad news. Let's jump back in it. That doesn't mean debts are getting much smaller. Americans ended 2017 with $91.6 billion in new credit card debt, the largest annual amount since 2007, and 104% above the post-recession average. Outstanding credit card debt is at its second highest point since the end of 2008, the report said. In 2017, Americans hit a record high of $1.021 trillion in outstanding revolving debt, often categorized as credit card debt. In April 2018, they still had more than $1.03 trillion to pay off, according to the Federal Reserve. Consumers' recent debt payoff, quote, is not as dramatic as the dollar amount makes it seem, said Nick Clements, the co-founder of personal finance company Magnify Money, who previously worked in the credit industry. Of course, Magnify Money, sponsor of our Stacking Benjamins podcast. The reason the total amount of credit card debt Americans have has also been growing. What's more, the first quarter of every year tends to look stunning for debt payoff, Clements said, because so many people spend massively in the fourth quarter of each year during the holidays. Then during the first couple months of the new year, they use work bonuses to pay holiday debt back. Another factor, more companies are now offering personal loans, Clements said, which can sometimes have lower interest rates than credit cards. When consumers use these loans to pay off the credit card debt, the debt is considered paid off. So what am I saying? I'm saying, kids, a little bit of smoke and mirrors going on. We ran up more debt than ever in the fourth quarter of last year, and we did a good job of paying most of that down. High five. Not quite the big high five we were doing a couple minutes ago, is it? It's a little ugly. It is actually way ugly and very sad, because at some point, I hope we get the message. We get the memo. Doesn't matter how you pay down debt. Get the debt paid down, right? Get the debt paid down. It's so amazing. I remember early in my post-college life, and actually, it's funny. I had just gotten married. We were on our honeymoon. Of course, like all good honeymooners, we went to Charleston, South Carolina. That's not the important part. The important part is we also went to Walt Disney World, because that's where you go, right? If you want to spend 6 bags of money. But even better than that, because back then, as I've said previously, I was horrible with money. I was just rotten with money and made some stupid moves. Another stupid move, we put most of that on credit cards. Didn't have the money to go. Hey, it's my honeymoon. I deserve it. Horrible. The next time, and actually future trips to Disney with kids, we always pre-saved using cash. Our trip to Germany this year, we set aside a special fund. We saved into that fund. And now we already have most of our Germany trip paid for. I have 3 hotel rooms to pay for. And that's it. Everything else, plane there and back, hotel rooms most of the nights. We're there for 13 days. We've got 3 days left to plan. And you know what? That's already on schedule. We set up these little milestones and then we do it ahead of time. And then when I'm on that plane to Germany, I'm not thinking at all while I'm going to Bavaria to have Wiener Schnitzel and big steins of beer, baby. I'm not thinking at all about how the hell am I going to pay for this later? It's already paid for. It's so much better. It's so much better. So, and if you can't afford to save any money toward that vacation, but you really want the vacation, go check out our episode over on the Stacking Benjamins podcast with Harry Campbell, who drives for Uber. And it's amazing how easy that is. And maybe driving Uber isn't for you, but I'll tell you, there's so many easy ways to make money online now. And then set that money aside, and that becomes your vacation fund. And I realize that credit card debt's not just about having fun. Listen, sometimes there's medical bills, but a lot of times there's hamburgers, and a lot of times there's Disney World. And so do the part that you can, find ways to pay it off, go on the attack. That's our first lesson of the day, kids. Here at the Halfway Point, I'd like to say hello to our friends who watch live on Facebook. We do this live without a neck in front of a studio audience on Facebook. And we got a little chatty crowd here today. We got Daryl here. Hey, Daryl. Daryl likes our new smooth jazz that we use under my new pre-open. Thank you very much. Ryan's here. Cade is here. John says, and yet we still can't seem to get the national debt under control. John, it's a whole different podcast, baby. Large scale economics is not it. I love the idea of thinking globally, right? Think big picture, but act locally, right? Maybe we'll talk about that also in a second here. George is here with us. Hey, George. George says, just think about how much interest those folks paid to get all those points and airline miles. Right. You know, what's sad is that I love playing the airline reward game. I love playing it. And listen, if you pay your debt off every month, even using something like a debitize to make sure that it gets paid off every month, and you take advantage of that. But that's not why they have the reward point game, is it? And George knows you're paying 27% interest, but hey, I scored 2% cash back. Okay. Yeah. Smoke, meet me ears. Cade says Dave Ramsey sweating bullets with this headline. Well, the headline, the first half of the headline, Cade, looks awesome. It looks fantastic. The second half of the headline, and digging into what Nick Clements is saying, not so much. John's back and says, because credit card debt's fun debt, student loans are for work, right? Credit card debt for me was fun debt. And then the second half of it, paying it off, not so much. And I'm sure it's like that for most of the people that have had credit card debt that are listening. Hey, our friend Aja's here, says, hey. And Paul, I believe, is here. Paul or Shireen is here with us. Hey. And Aja says, never pay interest, period. Go back and listen to Aja's show on Stacking Benjamins a couple of weeks ago and her story. She knows about paying interest. If you want to know a great story about somebody that paid off a bunch of interest and did some crazy stuff to get her family out of debt. It's awesome. I love people that just take control, and Aja and her family certainly did that. Hey, let's jump into our second headline, guys, which comes to us from financialplanning.com. It's the nerdy publication where nerds like me hang out, financial planners, former financial planners, and maybe you, if you want to go hang out and find out what financial planners are chatting about. But this one is something everybody worries about. It's written by a guy named Andrew Schilling, and it's Can Diversification Protect Against the Next Crash? We want to know about that, don't we? Out of Chicago, are your clients diversified enough for the next major stock market crash? It's been almost a decade since the financial crisis. While there have been various sell-offs and flash crashes that have tested the limits of client portfolios since, many industry leaders are considering the likelihood of a repeat and just how well prepared the industry will be or when that day comes. And by the way, just to go off, I guess, on this a little bit, everybody worries about that. Isn't that what we all worry about? We all worry, will diversification help save us from the next market collapse? How can, and not even diversification. That's not the question we ask. We're like, can we do this? Is there a way, Joe, that I can get rid of the next market? Because I think I can. Or I've got this money. Why don't I wait until the market collapses and then I'll put it in? That's another big question that we get all the time. And by the way, if you're thinking that, don't feel bad. Most often asked question. So it isn't you. It's everybody. Because we think we can. And we definitely want to. I don't want to lose money. Do you want to lose money? No. You don't go up to the roulette table in Vegas to lose. You go there because you got dreams of winning big. You buy a lottery ticket, you're dreaming big. You are in the stock market, which isn't lottery and it's not gambling, but certainly you can lose money. So let's jump back in. There are signs that lessons have been learned from the financial crisis as advisors now have a deeper understanding of how client portfolios should be constructed, said panelist Ann Lester, head of retirement solutions for JP Morgan Asset Management's Global Investment Management Solutions. Now the wealth management industry is generally better at measuring risk and understanding its ripple effect on various parts of a client's portfolio, Lester explains. They talk about a way to get a little further down. They talk about ways to manage this. One way is to have treasury bills. And the answer was, can treasury bills help you? Can moving your money to treasury bonds, can that help you actually get out of debt? And the answer here is, you did not get out of debt. Can it help you avoid a market crash? The answer is yes. But also the answer there is timing. And I actually think that moving your money to treasuries is horrible. And it's horrible because you have to guess the day to go to treasuries and you have to guess the day to get back out. So it's not about treasuries, but treasuries are very safe. And baby, if you can pick the day, both days, the day to get in, the day to get out, and not lose all that upswing that happens generally just after the crash, right? Where you'd want to be in. If you can do that, fantastic. Sign me up. Where can I get in your newsletter? I want to do that. You can't do that. Nobody can do that. You got to be right twice. You can't do it. So I don't like treasuries. So then the second way based on simplistic metrics like stocks and bonds or US versus non-US. Take our target date series. That is a portfolio for everybody from age 20 to 95. Most have a shape of their equity allocation that starts at all equities and goes down. Not only is the equity position changing, the type of equities are also changing. A sign that clients are embracing these changes is their willingness to adapt, says Judith Ward, who's been on this show, by the way, not this show, Stecky Benjamin, sorry, senior financial planner at T. Rowe Price. As they head into retirement, we see lots of retirees are flexible in their spending. They're willing to tighten their belt rather than take an extreme loss. When it comes to diversification, and can diversification help? The answer is right here. I'm looking for it. If you held on to your cores, which admittedly is easier said than done, you would have seen during downturns that diversification works. It just didn't work in a very narrow time frame. And I think, kids, that is the lesson when it comes to diversification, saving your portfolio. Diversification will save your portfolio. It can't be overly simplistic. It's funny. I'm not a huge fan of gold, but gold acts so differently in a portfolio than other asset classes. For a lot of the portfolios, when I was managing money, you put a 5% allocation in gold, and because it's so flippin' random how gold works, it's a great diversifier even for an aggressive portfolio. So if you're just looking at the bottom line, 5% in a precious metals position can be fantastic. I can't stand gold. I mean, and it's because people go, well, gold, I'm afraid of stocks. I'm going to don't put all your money in gold. So gold is a portfolio driver I don't like. Gold as an anchor to kind of give you a smoother ride, even though gold is not smooth. Gold moves up and down 8 times faster than the U.S. stock market does, according to my friend Walter Updegrave. You don't know who Walter Updegrave is. According to my buddy Jim down at the Walmart. That's not it. Walter Updegrave, great writer. Look him up. Fantastic. We got to get him on the show sometime soon. And I think I've been saying that for like 5 years. But Walter, brilliant writer who studies lots and lots of financial topics. But this is one where I quote Walter often. 8 times more up and down in gold than in stocks. And people tell me, I don't like the bouncing around of stocks, so I'm going to gold. Good luck with that. Put on my Dr. Phil hat. How's that working for you? Diversification is great, but you got to think longer term. And certainly when the market comes up, that's when you want to be in the market. And sadly, you got to have a little down, and you can control that down a little bit by looking at a proper asset allocation based on your goal. You can do one of these silly risk tolerance charts that tells you how to allocate. I don't know why you do that. Look at when you need the money. Where do you think you need the money? Maybe even move it up 5 years. Go to something that looks at this thing called the efficient frontier. Build that pie chart. And then There you go. That's the way that you start. It isn't hard. It is not difficult. Or even use something like a Bloom, with your 401k and match that up. It's way better than just the simple. I don't like taking lots of risk. What if you don't meet your goal? That's not good. So diversification for the win. Absolutely. All right. We got a big idea coming up in just a second, but first got to say one more word about Tiller. If you're somebody who doesn't see yourself as a spreadsheet nerd, I know we talk about Tiller being great for spreadsheet nerds like mom, but even if you're not a spreadsheet nerd, being able to simplify your data and change your data is fantastic. I switched from Tiller over from Clarity Money just this last week. And the reason is because when we had Peter Polson on from Tiller on our Facebook Live last week, you know what I found out? I can make Tiller simpler. Like I can take out all the stuff that I don't like, make it however I want because it's built on Google Sheets and now in beta being built on Excel. I can say, I don't like that. I want to put these two categories together. I want to make it really simple. I love it simple. I want my dashboard simple. Some people like it really complex. Whether it's complex like mom or simple like me, Tiller's a great place. And to help the show and to help yourself, if you head to stackingbenjamins.com/Tiller, when you go there to check it out and you decide to buy, they send us a little thank you for sending you their way. That's stackingbenjamins.com/Tiller. All right. We talked about two big things today, didn't we? Number one, we talked about getting out of debt and about how it looked like Americans are getting out a lot of debt. No, we're just paying back the big party we had the fourth quarter. Sadly, I'm sorry. I wish we were getting out of debt because that'd be so much better. And then the second headline, all about diversification. If you don't look narrow term, you look longer term. Diversification keeps you in the game, and diversification can make that downturn go a little softer, and then you're still in the market when it comes time to come back in. Much better than trying to play the treasury game, which also was presented in this article. The big idea between both of those, whether it's paying off debt, which sometimes we hear about these people that have $100,000 of debt. Aja, who's hanging out with us today on Facebook, Aja had a ton of debt. She didn't think today. She didn't think tomorrow. You got to think long term. It took her a couple of years to pay off her debt, and that still was quick. I mean, you'll see people that have tons and tons of debt. It takes them a long time. Think long term. I know we live in this society where we want stuff right now, but if we think long term, we're going to be better. Now, I'll tell you, when I say think long term, people go, yep, I'm thinking long term, which means I'm going to pay back that debt much later. I'm just going to worry about short term stuff now, Joe. Not going to worry about, no. Think short term, act short term. Let me rephrase that. Take two. Act short term, think long term. Always be on the offensive short term, but in terms of your global outlook, think long term and set yourself milestones. Give yourself high five. Listen, if you got $100,000 in debt, every $10,000 in debt, high five yourself, right? Just have a little inexpensive, frugal party to celebrate the fact that you are 1/10 of the way there. And then you're 2/10 of the way there. I do that when I run a marathon. I'd think, I got the hard first 3 miles out of the way. I only have 23 to go. Much better. I think that's the key. All right, kids. Thanks for hanging out today. Everybody on Facebook, thank you for hanging out if you're listening to the show. We'll see you next time. Go stack some Benjamins. Bye-bye.
Money in the Morning is created by Joe Saul-Sehy and is brought to our channels by our producer and engineer, Richie Rutter-Reese. Stacking Benjamins and Money in the Morning are for entertainment purposes. Before making moves, consult with your financial advisor. Looking for training sessions? Kathleen Selmans has a great suite of Stacking Benjamins tools, so head on over to learn.stackingbenjamins.com. Hoping to chat with us on the web? Say hello to Shannon Cowan, our social media guru and community manager in our Facebook group. She can be found at stackingbenjamins.com/basement. From the basement, I'm Joe's mom's neighbor, Doug. See you tomorrow.